On February 25, 2022, the day after Russia invaded Ukraine, the United States, the European Union, the United Kingdom, and their allies announced what they described as the most sweeping package of economic sanctions ever imposed on a major economy. $300 billion in Russian central bank reserves were frozen overnight. 7 of Russia's largest banks were cut off from the SWIFT international payments network. Export controls blocked semiconductors, aerospace technology, and military equipment. Over 1,000 multinational corporations announced they were withdrawing from Russia. The ruble collapsed 40% in days. Western officials predicted economic catastrophe. The International Monetary Fund forecast an 8.5% contraction of Russia's GDP in 2022. Financial analysts described the sanctions as an economic nuclear weapon, a tool that would defund the Russian military, collapse the domestic economy, and force Moscow to the negotiating table within months. Russia's actual GDP contracted by 2.1% in 2022. In 2023, Russia's economy grew by 3.6%, faster than Germany, faster than the United Kingdom, and faster than most of the countries that had imposed the sanctions. This is the story of how the most sophisticated financial attack in history failed to achieve its primary objective, and what that failure reveals about the actual architecture of global economic power. The single most important reason Russia survived the sanctions is one that Western governments either failed to anticipate or failed to prevent. Its oil never stopped flowing. Russia is the world's second largest oil exporter. In 2021, energy exports generated approximately $500 billion in revenue, roughly 30% of the entire Russian government budget. The sanctions architects understood that cutting Russian energy revenue was essential to making the sanctions work. What they underestimated was how quickly the market would reroute around them. In the weeks after the invasion, oil prices spiked to $120 per barrel. Russia was selling its oil at a discount, $15 to $20 below market price, but it was selling enormous volumes at an elevated global price. The net effect was paradoxical. Russia's oil revenue in 2022 actually increased compared to 2021 despite the sanctions because the invasion itself had caused the price spike that made discounted Russian oil profitable. The G7 introduced an oil price cap of $60 per barrel in December 2022, designed to limit Russian export revenue while keeping Russian oil flowing to prevent a global energy crisis. The cap required any Western-insured or Western-flagged ship to refuse to carry Russian oil priced above $60. Russia responded by building what has become known as the Shadow Fleet, a network of over 600 tankers operating outside Western insurance, Western flags, and Western financial systems. These ships, purchased through intermediaries in the UAE, Turkey, and Hong Kong, carry Russian crude to India and China without touching any Western financial infrastructure. India, which imported negligible volumes of Russian oil before 2022, became Russia's second-largest oil customer within 18 months, purchasing discounted Russian crude, refining it at Indian refineries, and selling the finished diesel and jet fuel back to Europe. European companies that could no longer buy Russian crude directly were in effect buying Russian oil molecules through Indian refineries. The sanctions had created a laundering mechanism at industrial scale. By 2023, China was purchasing 2.5 million barrels of Russian oil per day, nearly double pre-war levels. India was purchasing 1.5 million barrels per day, up from essentially zero. Together, China and India absorbed most of what Europe had stopped buying. While the oil rerouting was solving Russia's revenue problem, Moscow was simultaneously executing a transformation of its financial architecture that had implications far beyond the immediate crisis. Before 2022, the Russian ruble was primarily backed by dollar and euro reserves, and the majority of Russia's international trade was conducted in Western currencies. The sanctions changed that calculation permanently. Russia's central bank rapidly restructured its reserve composition toward yuan, gold, and currencies from non-sanctioning countries. Trade with China, which had been conducted largely in dollars, shifted to yuan. By 2023, 36% of Russia's export revenue was being settled in yuan, up from near zero in 2021. Russia-China bilateral trade reached a record $240 billion in 2023, conducted almost entirely outside the dollar system. The SWIFT cutoff, which Western officials had described as Russia's financial death sentence, drove Russia to accelerate the development of SPFS, its domestic alternative to SWIFT, and to expand connectivity with China's KIPS payment system. Russian banks cut from Western networks began routing international transactions through Chinese correspondent banks, through Turkish financial institutions, and through a network of smaller banks in the UAE, Kazakhstan, and Armenia that maintained connections to both the Russian and Western financial systems. Visa and MasterCard suspended operations in Russia in March 2022. Russia's domestic payment card Mir had been in development for years as a contingency system. It was already operational in Russia when the Western cards left, and Russian consumers barely noticed the transition for domestic transactions. The system's international reach was limited, but for the domestic economy, the infrastructure was already in place. If the shadow fleet is the mechanism by which Russian oil reached global markets, Turkey is the mechanism by which global goods reached Russia. Turkey is a NATO member. It is also a country that refused to join the Western sanctions regime, and that refusal created the most important commercial corridor in the war economy. Turkish exports to Russia increased 70% in the 12 months following the invasion. German machinery, Dutch electronics, American semiconductors, and South Korean components, goods banned from direct export to Russia, flowed from their countries of manufacture to Turkish distributors, who then shipped them east. This process, which Russian customs documentation described as parallel imports, became so systematic that Turkish trade statistics for 2022 showed import surges in categories that corresponded precisely to the goods Russia most needed. The semiconductor shortage was Russia's most acute problem. Western export controls had successfully blocked direct shipments of advanced chips. Russia's response was documented in captured military equipment. Engineers found that Russian weapon systems were being built using chips pulled from household appliances, washing machines, refrigerators, dishwashers, because industrial-grade semiconductors were unavailable, but consumer electronics chips were still entering Russia through third-country routes. By 2023, the US Treasury had sanctioned dozens of Turkish, Armenian, Kazakhstani, and UAE companies for facilitating sanctions evasion. The networks adapted. New intermediaries appeared. The fundamental problem was structural. The West represents roughly 15% of the world's population and controls a declining share of global trade. The other 85% was not participating in the sanctions. None of this means the sanctions had no effect. They did in specific, measurable, and damaging ways. Russia's automobile production collapsed 68% in 2022, as Western parts and components became unavailable. The domestic automotive industry, which had been assembling foreign-brand vehicles under license, lost its supply chain overnight. Russian roads began filling with Chinese automobiles.
Russian commercial aviation was severely disrupted.
Sanctions blocked spare parts and maintenance services for Boeing and Airbus aircraft, the planes that make up the vast majority of Russia's commercial fleet. Russian airlines grounded hundreds of aircraft and began cannibalizing others for parts. Domestic routes continued, but the long-haul international aviation network that connected Russia to the world effectively collapsed. The brain drain was perhaps the most damaging long-term effect. Between 700,000 and 800,000 Russians, disproportionately engineers, software developers, scientists, and entrepreneurs, left the country in 2022. The cities of Tbilisi, Yerevan, Istanbul, Belgrade, and Dubai received waves of Russian professionals who had no intention of returning. The long-term economic cost of losing that generation of talent cannot be measured in a single quarterly GDP figure. Inflation peaked at 17.8% in April 2022, before the central bank raised interest rates to 20% to defend the ruble. The aggressive monetary response worked. The ruble recovered most of its losses by mid-2022. But interest rates at 20% crushed consumer lending, mortgage markets, and small business investment. In the background of every sanction negotiation, one question has never been resolved. What happens to the $300 billion? The frozen Russian central bank reserves are held primarily at Euroclear in Belgium, the world's largest securities settlement system, with smaller amounts at the US Federal Reserve, the Bank of England, and central banks in France, Germany, and Japan. The money sits there, frozen, generating interest of approximately $5 billion per year. The G7 has agreed to use the interest, approximately $50 billion over 10 years, to fund Ukraine reconstruction loans, backstopped by the assets. But seizing the principle, the $300 billion itself, has proved impossible to execute for one reason that no Western official will say clearly in public. If the US government can freeze and seize the sovereign reserves of a major power, every other country holding dollar reserves must ask whether the same could happen to them. China holds $3.2 trillion in foreign exchange reserves, the largest in the world, with significant dollar exposure. Saudi Arabia, the UAE, Brazil, India, every major economy that has remained neutral in the Ukraine conflict watches the $300 billion question with extraordinary attention. The moment the West formally seizes Russian assets without a legal process, the incentive for every non-Western sovereign to reduce dollar holdings accelerates dramatically. The $300 billion sits frozen, too dangerous to seize, too embarrassing to return. Here is what Russia's economic survival actually proves. Sanctions work when the target is isolated from the entire global economy. Russia is not. China, India, Turkey, the UAE, Brazil, and dozens of other major economies continued trading with Moscow throughout the war. The West imposed the most comprehensive sanctions package in history, and it reached less than half of global GDP. The deeper consequence is not Russia's survival. It is what Russia's survival demonstrated to every other country on the American sanctions list, and every country that could theoretically be added to it. Iran survived 40 years of sanctions. Russia survived year 1 with GDP growth by year 2. The template now exists. A large enough country, with enough natural resources and enough willing trading partners, can absorb Western financial pressure indefinitely. The sanctions did not end the war. They did not collapse the Russian economy. They accelerated the construction of alternative financial infrastructure, yuan payment rails, shadow fleets, parallel import networks that will outlast the conflict and serve the next country that finds itself on the receiving end of Western financial power. The $300 billion remains frozen. The ruble trades, the oil flows, and the financial architecture that was supposed to isolate Russia from the global economy has instead created a parallel global economy that does not need the West at all.